This week's market looked calm on the surface, but underneath, chaos. The S&P barely moved, yet small caps got crushed by nearly 2%. Why? Because the Fed is flying blind, and that changes everything for investors like you. I'm Burke, head of investments at ValueAligned Partners. For over 2 decades, I've helped investors navigate exactly these kinds of markets, where the headlines don't tell the whole story. Today, I'm breaking down what really happened this week, why a 43-day government shutdown created a data blackout that's keeping rates higher for longer, and most importantly, what you need to watch next week when NVIDIA and the big retailers essentially become our new economic data. Let's go. Market in stasis, rotation in chaos. That's the perfect description of this week ending November 15th, 2025. The major indices? Essentially flat. But the internal rotation, the money flowing between sectors and market caps, was violent. This is what happens when the market loses its compass. And that compass? It's the Federal Reserve's data. Here's what I mean by deceptive calm. The S&P 500, that's SPY, finished up just 0.1% at $671.93. Year-to-date, we're still up a solid 14.5%. The NASDAQ 100, the QQQ, down just 0.1% to $608.86, holding on to an 18.6% yearly gain. But look at small caps. The Russell 2000, ticker IWM, dropped 1.7% to $237.49. That's 10 times worse than the large caps. And year-to-date, only up 7.1%, less than half the S&P's return. This divergence tells us everything. Small cap companies are more sensitive to interest rates, more dependent on domestic growth, and more likely to be affected when the Fed signals it's staying tight. These stocks get hammered. The 43-day shutdown just ended, but it removed the critical October inflation and jobs data the Fed needs to justify rate cuts. Now, it wasn't all bad news. Some stocks had exceptional weeks, revealing where the smart money was hiding. First, Albemarle, ticker ALB, up over 18%. This lithium producer crushed Q3 earnings, and analysts are getting excited about renewed EV demand. Second, Sealed Air, SEE, is also up 18%. Why? Private equity is circling, with acquisition talks underway. When the buyout firms show up, shareholders win. Third, Cisco, CSCO, up nearly 10%, hitting a 25-year high. They beat on earnings and raised guidance, all thanks to AI infrastructure spending. Every AI data center needs networking equipment, and Cisco dominates that space. And fourth, Merck MRK, up 7.7% on news they're acquiring Sedera Therapeutics for $9.2 billion. That's strategic. Merck's blockbuster drug, Keytruda, faces a patent cliff in 2028, so they're buying pipeline now. Notice the pattern? Earnings beats, M&A catalysts, and AI infrastructure. Those are your market leaders right now. But for every winner, there were losers. And these tell an important story about what investors are worried about. Disney, DIS, down 5.74%. They missed on Q4 revenue at $22.46 billion. And the real problem? Their traditional TV networks business is structurally broken. Cord cutting isn't slowing down. Tesla, TSLA, fell 5.86% on a double whammy. Their China sales hit a 3-year low in October. Market share collapsed from 8.7% to just 3.2%. Plus, they got caught in the broader tech sell-off, as high valuation growth stocks suffered from rising rates. And NXP Semiconductors, NXPI, down 3.65%. The whole semiconductor sector sold off, and it didn't help that their CFO sold $1.47 million worth of stock. Insider selling always makes investors nervous. The common thread? Consumer weakness and tech valuation concerns. When rates rise, these high multiple stocks feel it first. So where did the smart money actually go? Let's look at sector rotation, because this is where you really see investor psychology. Healthcare, XLV, led the market, up 3.6%. We already mentioned Merck's acquisition, but Eli Lilly also surged nearly 11% on momentum in their obesity drug franchise. The GLP-1 drugs, Wegovy and Zepbound, are becoming a $100 billion market, and Lilly dominates. Energy, XLE, up 2.5%. And here's what's interesting. Oil prices were flat, yet energy stocks rose. Why? The market priced in a new geopolitical risk premium. There was an Iranian tanker seizure and a Ukrainian drone strike on Russia's Novorossiysk oil terminal. Geopolitical chaos equals an energy insurance premium. But consumer discretionary, XLY, down 2.6%, the worst performer. This is your Amazons, your Teslas, your retailers. Investors are getting nervous about the U.S. Consumer heading into the crucial holiday shopping season. Bottom line, money moved into defensive sectors with pricing power and away from consumer-dependent, rate-sensitive plays. Now let's talk about the elephant in the room. The government shutdown that just ended. President Trump signed a funding bill on November 12th, ending a record 43-day shutdown. That's the longest in American history. The economic damage? Significant. The Congressional Budget Office estimates that a 0.5 percentage point reduction would reduce Q4 GDP growth to a complete 1.5%. Even worse, there's a permanent $11 billion loss to real GDP by the end of 2026. That's money the economy will never recover. But here's what really matters to markets: statistical blackout. The October CPI report? Canceled. The October unemployment rate? Canceled. The Bureau of Labor Statistics couldn't collect data for most of October because its staff was furloughed. Think about that. The Fed makes decisions based on data. No data means no confidence to cut rates. So by default, policy stays tighter. That's why small caps got crushed. Higher rates for longer wasn't a Fed decision. It was a shutdown consequence. This brings us to the Federal Reserve, and they're in an impossible position. Boston Fed President Susan Collins explicitly said she would be hesitant to ease policy because of the lack of information. The Fed literally doesn't know what inflation did in October, or how many jobs were created or lost. The market's reaction was swift. The 10-year Treasury yield spiked to 4.15%. That's mortgage rates, corporate borrowing costs. Everything rises with it. The 2-year Treasury hit 3.62%. And here's the kicker. Odds of a December rate cut collapsed from 67% down to just 46%. In 1 week, the market went from expecting a cut to basically a coin flip. This is what I call policy by vacuum. In the absence of data, the Fed defaults to caution. Caution means higher rates. Higher rates mean pressure on stocks, especially small caps and anything with debt. So when you hear the market was calm this week. No, the market was repricing an entirely new Fed path. That's not calm. That's a tectonic shift happening under the surface. So, how did the value aligned portfolio navigate this chaos? The VAP was up 1.6% net of fees and expenses and is now up 17.67% net of fees and costs for the year. Let me show you our top performers and why we own them. Eli Lilly, LLY, up 10.9%. This wasn't luck. We've held Lilly because they have a dominant position in the $100 billion obesity drug market. Tirzepatide, their GLP-1 drug marketed as Mounjaro and Zepbound, is crushing it. Plus, healthcare is defensive when consumer spending gets shaky. Cisco, CSCO, up 9.8%. We own Cisco specifically for the AI infrastructure build-out. Every single AI data center being built needs networking equipment, switches, and routers. That's Cisco's bread and butter. They beat earnings, raised guidance, and confirmed the multi-year spending wave is real. And Merck, MRK, up 7.7%. This $9.2 billion Sedera acquisition is smart capital allocation. Keytruda generates $25 billion in annual revenue, but faces patent expiration in 2028. Buying pipeline now is precisely what disciplined pharmaceutical companies should do. Notice the pattern? We own businesses with durable competitive advantages, clear catalysts, and the ability to grow regardless of Fed policy. That's value-aligned investing in action. Now that transparency is critical, let's talk about what didn't work this week. Tesla, TSLA, down 5.9%. This one hurt. China's sales collapsed to a 3-year low in October, with market share dropping from 8.7% to just 3.2%. Competition from BYD and other domestic Chinese electric vehicle makers is fierce. Amazon, AMZN, fell 4%. This was mostly sector weakness in consumer discretionary. But there's also a strategic story here. Amazon is backing new legislation, the GAIN AI Act, to restrict chip sales to China. That signals they're worried about AI compute resources and want to secure domestic supply. And installed building products, IBP, down 2.8%. This is a housing-related stock. So when the 10-year Treasury yield rose to 4.2%, mortgage rates followed, and housing stocks felt immediate pressure. There was no negative company news. This was pure macro-driven pain. Here's what's important. None of these are bad businesses. They're great companies caught in short-term macro crosswinds. In our value-based approach, we evaluate individual business performance rather than stock price movements. These positions stay on our radar, but we're not panic selling into volatility. So what should you be watching next week? In the absence of official government data, corporate earnings become our economic dashboard. Tuesday, November 18th, Home Depot reports. This is your first major read on the U.S. consumer and housing market. We'll get real data on big-ticket purchases and contractor spending, the pro segment that drives their margins. Wednesday, November 19th, NVIDIA. This is the event of the week. NVIDIA doesn't just report earnings. They set the narrative for the entire AI trade. If Jensen Huang raises guidance and says data center spending is accelerating, tech rips higher. If he cautions on supply or demand, we could see the valuation reset accelerate. Also, Wednesday and Thursday, Target, Lowe's, and Walmart. These retailers become our substitute for the canceled October retail sales data. Their guidance on holiday shopping and consumer health matters is enormously essential. And Friday, November 21st, flash PMIs and FOMC minutes. The PMIs are the first comprehensive November economic activity data we'll get. The Fed minutes reveal what they were thinking before this data blackout hit. Here's the key insight. With October's official data missing, corporate guidance becomes, in effect, Fed policy input. What NVIDIA and Walmart say about demand will move interest rates. Words become data. Data becomes policy. Policy moves markets. That's a very different market environment than we're used to. So let me bring this all together for you. This week looked quiet, but beneath the surface, we saw a significant defensive rotation. Money moved from small caps and consumer stocks into healthcare, energy, and quality large caps with pricing power. The 43-day shutdown created a data vacuum that's keeping the Fed on hold. That's pushing rates higher and putting pressure on rate-sensitive assets. For the value-aligned portfolio, we're leaning into businesses with durable competitive advantages and fundamental catalysts. Companies like Lilly, Cisco, and Merck that can grow regardless of Fed policy. Next week, NVIDIA and the big retailers will become our economic compass. Their guidance will literally influence Fed policy because official data is missing. If you want help navigating markets like these, where the rules are changing and individual stock selection matters more than ever, I invite you to schedule a free consultation with our team. The link is in the description below. Remember, we don't believe in get rich quick. We believe in doing your homework and working with professionals who act as your fiduciaries 100% of the time. I'm David Berkowitz. Thanks for watching, and I'll see you next week.